Why financial ratios are very important for bankers when they assess or appraise for the loan. Just look at this scenario. You have current assets for the current year and previous year. When you look at this standalone information, what you can make out is current assets have improved because in the previous year it is 100 million, in the current year it is 110 million. It looks like there is an improvement because assets are increasing. But if you get another piece of information, let's say the current liability, and if you look at the previous year, it is 75 million, and in the current year, it is 120 million. So what this communicates, in the previous year, they had current assets of 100 for current liability of 75. It means they had more resources for meeting the obligation, whereas in the current year they are having current assets of 110 only for meeting the obligations of 120. It means in the previous year their current ratio was very comfortable at 1.33, whereas in the current year 110 by 120 their current ratio is only 0.92. So look, standalone information is deceiving, but when you measure the same through ratios, you will get a better picture. Here liquidity is strained in the current year. To learn more, just comment 7D and join our 7 days free WhatsApp bootcamp.